Good day, and welcome back to the Life License Qualification Program video series presented by Business Career College Corporation. My name is Jason Watt, and the topic we're going to be talking about today is universal life insurance. Now, hopefully at this point, you've seen the videos concerning life insurance overview and term insurance and whole life insurance. And if you have, then you're probably ready to learn about universal life. So, universal life is a relatively new product. It was introduced in the early 1980s, and it incorporates some features of some of the insurance products we've looked at so far. It also incorporates some features of some of the investments that you will have looked at back in Module 6. So, universal life insurance is best understood by looking at its 5 characteristics. And the 5 characteristics of universal life insurance are, first off, this policy type features flexible premiums. It also features flexible coverage and flexible investments. If we wanted to summarize universal life in one word or less, the word we might choose, flexible. So this product is a flexible product. It gives a flexibility that we don't have with other sorts of products. The ability to manipulate the amount of money we're putting into the policy. The ability to manipulate the amount of death benefit that's going to be paid. And the ability to manipulate the underlying investments. Now, who is going to take advantage of all that flexibility? Well, this ball goes in the client's court. It's really up to the client, the policy owner, to take advantage of all this flexibility that we offer them. So this flexibility comes about, and then we would say it's up to the client to take advantage of it. This is a consumer accountable product. Now, that consumer accountability means that we're going to have clients here who understand a little bit about how this works. You don't have to be a professional stockbroker to manage a universal life policy, but you have to have some willingness to manage your own investments and some willingness to look at your statements every year and make sure the policy is still doing what it's supposed to be doing. If you have a client who is likely never going to do those things, then they probably shouldn't be using a universal life insurance policy. But if the client is going to regularly track their investments and is going to say, does this premium match with my expected goal, or does this death benefit match with my expected goal, on a periodic basis, then universal life insurance is probably appropriate for them. The 5th characteristic we're going to see then is that the client has the opportunity to see exactly what's happening with the policy. Universal life insurance products are transparent, or sometimes we refer to this as unbundled products. That is, you can see exactly what's happening with the policy from the client's or the policy owner's perspective. So we're first going to look at kind of a universal picture that's used to illustrate universal life insurance. And you'll see this quite a bit. The picture usually looks something like this barrel or bucket or keg, whatever you want to call it. And what happens then is our client pays premiums, or sometimes we're referred to this as deposits. Sometimes when we want to give it more of an investment characteristic, we refer to this as deposits, but whichever, they're the same thing, the money that's going into the policy. So we have these premiums or deposits going into the policy. And if we can imagine that the policy then will develop some value based on the premium or deposit going in. This value we would call, and it goes by a number of names, the account value or the accumulation fund or the surrender value or the cash surrender value. All of those terms are used interchangeably to refer to this. Correctly, we would say the account value is the total amount in here, while the cash surrender value is the amount that's in here less any applicable surrender charges. And universal life, like whole life insurance, tends to have fairly high surrender charges for the first 8 to 10 years. The surrender charges tend to disappear at about the 8th or 10th year, meaning that if you want to access your cash value after that point, you could access the full value. If you want to access it earlier, you may be limited in how much you can access. So your account value then builds based on the performance of some underlying investments. And we can use a bunch of different types of investments, all things that you will have seen back in Module 6. You might have just a regular savings account here. You might use a GIC type investment or a term deposit, related ideas, both featuring guaranteed returns. You might have an index account. Indexed meaning that it's going to grow based on the performance of some other investment. Or you might have some mutual funds. Whichever investment we happen to choose, the client, when they exercise that consumer accountability, has the opportunity to move their money around. So you might find somebody who's initially 100% invested in Canadian equity. But then over time, maybe they move their investments around. Maybe they want some exposure to international markets. So maybe later on, they have 50% held in Canadian equity funds and 50% held in maybe European equity funds. And then, maybe a few years later, they've done well in the equity markets and they want to lock in some of their growth. So they now say, I'm going to have just 30% sitting in Canadian equity, 30% sitting in European equity, and I'll move the other 40% up into maybe a GIC or a term deposit type of investment to lock in some of my returns. It's up to the consumer how that's going to be managed, of course, with advice from a good agent. Now, this really doesn't show any life insurance at all. We have no life insurance represented here.